Welcome to video 14A, the first of our chapter 14 videos. And yes, we've made it. This is the last chapter in module 2. It also has limited coverage, so do not read the whole chapter. Make sure you look at the reading assignments. So let's think about what we've considered thus far. So back in chapter 5, we talked about gross income. And then chapter 7 talked about a certain segment of gross income related to investments like interest, dividends, and capital gains. Then we started talking about deductions and losses and some of the limitations associated with those. And we talked in detail about the timing of the recognition, right? So the tax law and the way it defines when we have to recognize an income or when we're eligible to recognize a deduction. And then we moved into compensation, right? Compensation is clearly an important part. It tends to be the form of income that the vast majority of U.S. taxpayers incur. So it's important to cover that from both the income perspective and, of course, the deduction perspective as well. So we're coming to this last kind of finite area within this small business, getting our feet wet on the fundamentals of how taxable income is calculated area. And frankly, it's a big one. So this has to do with your dwelling, right? So, and it doesn't have to be the one you live in all the time. It can be the one you live in part of the time. But just like we all had to eat, so meals and entertainment got a special rule. We all have to live somewhere. And the same sort of taxpayer tax law interaction exists here as well, where taxpayers, of course, want to try to get a business deduction for their living arrangements. And of course, the tax law does not want to give that because that's a personal expense. So we're going to talk about how dwellings, your home or rental home or a vacation home, are used in a way that's part for business and part for personal consumption use. And the tax rules, which are frankly extensive around that area. So 3 videos left. Hang in there. We're getting close. Let's get started. So as always, let's cover the learning objectives for this particular chapter of the module. So, as I previously discussed in that intro, we're going to talk about whether the home, your dwelling, is considered a principal residence, a residence that's not a principal residence, or a non-residence for tax purposes. We're going to talk about the tax issues and consequences associated with renting a home, including the deductibility of some part of a residential home. And then lastly, we'll talk about the requirements necessary to use your home in part as a business office. And we'll talk about the limitations by which the tax law controls us from doing that. Okay, let's start with the dwelling unit. So we talk about this idea of home, and I'll refer to it almost exclusively as a home, although sometimes I chuck in rental condo for contextual purposes. But a home, of course, can be a house. It can also be a condo or a mobile home. It can even be a boat as long as it has a bathroom and some bedrooms. So, the definition of dwelling unit is pretty broad. And a home can be used solely for personal use, right? So, for example, I live in my home. My family lives in my home with me. We don't rent it out. We don't Airbnb. We don't do home exchanges. We don't have anything going on that gives it any sort of business perspective. It's solely for personal use. You can also have a home that you have a mix of personal and rental use. So a lot of times this is the classic vacation home, right? So let's say you have a vacation home in Hawaii, but you live in San Diego. Well, you can't be in Hawaii 365 days a year, so maybe you go use your Hawaii home for a couple months, but the other 10, you could let it sit idle or you could rent it. And if you rent it, then you've now created a business use associated with that personal property. And then lastly, you could have a residence that you have solely for rental use, right? So you can have a pure out rental house or a rental condo or rental apartment, whatever it might be, that you own but you do not live in at all, and you solely rent it out for other people. Okay. So whether the dwelling unit is a residence or a non-residence, and as you can imagine, those are magical tax terms. Now, they're not really terms that are used broadly inside the tax code. So what you find is that different textbooks will use different names for these classifications. And I even have my own names, but I'm going to make sure we use the textbook names this time. So a residence or non-residence is depend on how it's used. So there are 3 categories of use. when the home is rented for any period of time. So think of it as if you don't rent it at all, then we're not even having this conversation, right? So you have to have at least rented it for some period of time, because otherwise it's just a home. So I have my terms and what I describe as the book terms. So let's go with primarily personal use. And that's when it's a principal residence, which means that the rent use must be very insignificant or minor. Let's skip down to number 3 and call that primarily rental use, or a non-residence, which means, you're really not living there at all. And then number 2 is the catch-all, right? So that's everything in between. So I call that the in-between category. The book calls it a residence not principal, which I think is just a great name. So these classifications are significant with respect to the recognition of income and deductions associated with that rental activity. So we have to start with deciding what are personal days and what are rental days. So let's start with the definition of what a personal use day is. So a personal use day is a day that as the taxpayer or some other owner, if it has multiple owners, stays in that home. So if you're staying there, that's clearly a personal use day. It's the day a relative of that owner stays in the home, even if that relative pays fair market value. So let's say you had a vacation home in Hawaii, like we talked about earlier, and your sister wants to stay there, and your sister doesn't have much money, so you rent it to her on the cheap, or maybe you just give her a complete 100% discount, right? Those are considered personal days. Now there is one exception to that rule. If in fact you're renting the home to a relative, that relative is paying fair market value, and that rental is their principal residence, then those count as rental days. So let's say you owned a home in La Mesa and your sister lived there with her family, and they basically live there year round, right? They sign a 1 or a 2 year lease like any other tenant. They're paying fair market value. Yeah, of course, those you get to treat as rental days. So if you're staying, if a non-owner stays in the home under a home exchange or a home swap, those are personal days, right? Because the idea is, well, just because you're staying in someone else's home, that doesn't mean that's business, right? You've done a home swap, and so there's no production of income or business going about that. And then lastly, any day you rent it out for less than fair market value, the idea being there must be some reason behind that. So rental days are when you do rent it out at fair market value, again, not to a non-relative, or days you spend there because you are there to repair or maintain the home for its rental use. So let's say you're, Bob Vila, and you like to fix the place up before the new tenants move in. And so the old tenants move out, you move in, and you spend 4 or 5 days doing some painting and some patching and fixing a few things. So you're there, you're living there, but those are considered rental days because you're just getting it ready for its intended use. Okay, so days the home that is available for rent but is not rented out, those are not personal days, and they're also not rental days. So just think of them as like unused days. I don't know what else to call them, right? So they're not personal days nor rental days. So this might be a situation where your tenant moves out, you go and you do the repairs, and you just aren't able to get a new tenant yet. So the place sits vacant for a couple months, a month, 2 weeks, well, however long. Those aren't personal days, but they're also not rental days. Okay, so we're going to go down the path of dealing with eventually the tax consequences of these classifications. But before we even go there, there's a couple of individual tax rules we need to understand because they affect the choices we make with respect to some of these deductions we're going to run into. Okay, so let's go through them piece by piece. They're in, I believe, chapter 6 of the book if you want to go back and refer to them. But there's a couple itemized deductions that individuals can take that are associated with their principal residence. So clearly, I live in my home, as I said, my family lives there, we don't rent it out at all. I am eligible to deduct my mortgage interest because that mortgage is secured by my principal residence. And so the interest I pay on that loan, I can actually deduct. That is an itemized deduction from AGI. The other thing I can deduct is my real property taxes. So there's an itemized deduction for state and local taxes. And I know we've talked about income taxes when we talked about the tax benefit rule. But you can also deduct your real property taxes. So you pay property taxes when you own a home, and those are deductible as an itemized deduction as well. Now that's subject to a $10,000 cap, but neither here nor there, right? We're not going to dig in on that so much. But know that these two items are deductible even though they are clearly personal expenses. Okay, and just so you're aware, a second home can also qualify as a residence for the purposes of the above two deductions. So you really can have two principal residences. You can deduct the mortgage interest on both of them, and you can deduct the real property taxes on both of them. Okay, so this is important that we understand this because, again, we may need to bifurcate those costs into their two pieces. The personal use piece, which we can deduct, and the business use piece, which we can deduct. Okay, so let's deal with category one, or as I like to say, primarily personal use. And again, what we're going to do is we're going to count the number of days that we either used it for personal or we used it for rental. So for it to be a primarily personal use, you must live in the home for at least 15 days. So you have to be in the home for more than 2 weeks, and you must rent it out for 14 days or fewer. So up to 2 weeks rental and no more than that. When that's the situation, the tax law says you can exclude your rental income, but you also are not eligible to deduct your rental expenses except those that are those personal itemized deductions, which we just discussed, home mortgage interest and real estate taxes. So let's say Mr. Hand lives in a condo in Atlanta, and that condo happens to be within walking distance of the Mercedes-Benz football stadium, which is the football stadium that the Atlanta Falcons play in, and happen to have hosted recently the Super Bowl. So in January 19, Mr. Hand is going to take his vacation to Hawaii. And he says, you know what? The reason I'm doing that is because it's Super Bowl week. And I can rent out my condo for 1 week for $4,000, pay for my whole trip to Hawaii and back. So this is a common outcome, right? When big events are in town, like the Olympics or the Super Bowl or the World Series or whatever they might be, you commonly see people rent their homes for very short periods of time. When that's the situation, as long as Mr. Hand lived in that home for 15 days, and as long as he rents it out for 2 weeks or less, the $4,000 of income he's going to receive is tax-free. So to the extent he pays for cleaning or any prep for those tenants for that 1 week, those expenses are non-deductible. Of course, Mr. Hand can deduct his interest and taxes as an itemized deduction as he might otherwise. So again, that's category one, primarily personal use. And remember, 2 weeks is kind of the magic measure for almost everything. So this is about renting it out for 2 weeks or less. Category two is in between. So we have to start with, well, you have to rent the home for 15 days or more. Because if you don't rent the home for 15 days or more, you're in category one, right? So we are clearly into category two here. And three also requires the same more than 15 days. But what happens is in category two, we've got this mix of rental use and personal use. So think of it as you rented the home for 364 days, but your personal use was 1 day. Is that really a mix that's enough to taint the deductibility of your costs? And the answer is no. Well, how about 2 days, 3 days, 4 days, 5 days, however many days it is? So we need to draw a line in the sand about the number of days that it would take to put some sort of personal taint on this rental property. And the tax law says if the personal use is the greater of either 15 days or more than 10% of the rented days, then you are in category two. So remember, you have to rent it for more than 15 days, period, right? And then your personal use would need to exceed the greater of 15 days or more than 10% of the rented days. And when this is the case, of course, all the rental revenues are included in gross income. To the extent you have expenses, you allocate them between the personal use and the rental use. However, if the property is used even for a day of personal use, well, that's not really a however, those expenses must be allocated. Well, we know that's the case because this is a mixed bag classification. You categorize your expenses as either tier 1, tier 2, or tier 3. that expense tiering matters because it's the order in which you're allowed to deduct those costs. So tier 1 is expenses to get tenants. So think of those as if you had to place an ad to get tenants. That's what they call a direct expense, and that's a tier 1 expense. And interest and property taxes, right? Those same two that we discussed a few slides ago because they are deductible anyway as a personal cost. Let's skip down to tier 3. Tier 3 is depreciation. Tier 2 is any other expense. So if it's not tier 1 and it's not tier 3, then it's a tier 2 cost. Now let's go into our final classification. Category 3 is primarily rental use, or as the book describes it, a non-residence. So again, rental days more than 14, right? So yeah, if I have 14 or fewer, I'm a category 1. On top of that, excuse me, the personal use days have to be 14 days or less than 10% of the rental days. So think of that as being the inverse of what we saw in category 2, right? If my personal use exceeds that level, then I'm a category 2, I'm an in-between. If my personal use is below that level, then I'm a category 3. Okay. The taxpayer in this situation includes all income and deducts all rental expenses. But again, these costs must be allocated. So you can have personal use in a non-residence. It just has to be 14 days or less than 10% of the rental days. So if that's the case, rental property taxes are allocated and the property taxes remain an itemized deduction. Interestingly enough, in what I would describe as a quirk of the tax law, when you allocate a portion of the interest to personal use, that is not deductible because you can only deduct interest on a principal residence. This one isn't even a residence, right? It is a non-residence classification. But what I would tell you is, unless taxpayers are using one of the softwares that catches that, it usually slips by and gets deducted. Okay, so here's a flow chart. There is a considerably more sophisticated flow chart in your textbook at the end of chapter 14, but this one actually gets it done, right? So let's start in the upper left. Was the home rented for 14 days or less? If yes, that's principal residence. No income, no deductions. It's over, right? If the answer is no, then you go down to the next decision box. Did personal days exceed the greater of 10% of the rental days or 14% of the days? If yes, then that's a residence, not principal. Your deductions are limited to your gross income. Otherwise, it's a non-residence and your deductions are not limited except for the itemized deduction for interest. Okay, so we spent a lot of time on the rules. We'll do applications in the next video. So thanks for watching. This is the end of video 14A.